get the question all the time, like, how does insurance work? Which is a better type of insurance? And there's people that have different philosophies. Term insurance is the way to go. No, IUL, Index Universal Life. No, whole life. So we're going to dive into the numbers because I got Chris Kirkpatrick here from 180, Life 180.
Yeah, man.
Life 180. So, and he can geek out on this stuff. I mean, you were
every day.
You were in product design for a long time, or
Yep.
you know,
Yep.
and poker player.
Yep.
So you've got this mind that can kind of go through this.
I love numbers. I'm a nerd, self-admittedly. You know, it's funny. I always say life doesn't exist on a spreadsheet, but I spend a lot of time in spreadsheets because
to demonstrate like how things could work.
Yeah.
We know that the only thing that's, you know, accurate is maybe the first day.
Well, and I
after
think
that, it's inaccurate.
And I think what's cool about this and why I love getting into the numbers is because once you understand all the nuances and all the numbers and how they work, you can see beyond the numbers on the spreadsheet, right? Like when you really get to know it. And that's where I end up fighting so much with the IUL agents and the whole conversation about all this. But I think this is going to be a fun video because what we did is we put together, you know, a good set of illustrations that are going to break down all the different ways, and it's whole life, base whole life, overfunded whole life, front-loaded overfunded whole life, term insurance, 10-year term,
looking
20-year
at
term.
different ways.
Looking at everything like across the board. And I think, you know, and we just evaluated them really quick. So, you know, I mean, we just literally threw this together and are putting it out there. And you just even notice like, whoa, when is the term premium equal the death benefit? And then, and so we're going to get into that. And it's really fascinating to like break down.
Right. Because we have what's happening immediately over the, you know, middle of the term and then the long term. And it's those different phases are important. So let's talk about whole life insurance has different riders. Let's talk about the different riders that you could use. And a rider is like this additional thing that you put on the policy that says this will be covered that wouldn't be covered without that rider.
Right.
And some of those cost extra money.
Yep.
And some of those don't.
Yep.
So a popular one is like waiver of premium.
Correct.
Right. So if you're disabled, after 6 months, they'll keep the premiums being paid if you're not able to go back to work.
Yep.
Accelerated benefit riders,
which are baked into different companies have different accelerated benefit riders. So you got to be careful. The living benefits of if you become chronically, critically, or terminally diagnosed.
Like if you qualify for long-term care, for example, if you have two activities of daily living of the 6 that you can't perform,
or cognitive.
And then all of a sudden you can tap into that death benefit and start using it while you're alive.
Super powerful.
So that's kind of baked in. PUA, paid up additions rider. That's a very popular one, also known as overfunded. Some people are saying, why would you ever pay more, right? That's because when you look at this as an expense, and you're like, well, I wouldn't want to pay more. I want to pay the least. And a lot of people in that framework go to term insurance. And I definitely think term has its place. It's a great stopgap to say, why don't you protect your economic value? Your economic value would be like if something happened to you, what amount of money would need to come in to replace that income?
Totally.
If that's important, I think it would be important in my world for my family. I want them to live the same lifestyle economically if I'm not around. I don't want to put them in a place where they're selling off assets or
Totally. That's the importance of a cover letter. And so when we look at this, you know, it's one of those things where if you say, hey, I'm not on this medication, and that underwriter then gets your medical information bureau report and they go, oh, you're on blood pressure medication. That wasn't going to be a deal breaker, but because you lied about it, you're done, right? Like, and that becomes a character issue on the application, right? Because if you're lying about that, what else are you lying about? And like all these things. And that's just like a flat stamp denial. And once you get denied, then it's a ripple effect.
Part of the record.
Now it's part of your record. And now every company is going to question it. So just be honest, you know, like just be honest. And as an agent, if you're watching this as an agent, like coach your clients to be honest and understand the power of your job as like a field underwriter and your ability to actually have influence and like help tell a story that makes sense to help your client get what they need.
Cool. So contestability period, 2 years. Underwriting process is part of that.
Exactly.
Anything else on the all right. So
I think we're good.
Let's look here at the policy.
All right, so this is a base policy. So what we're going to do is we're going to go through a base. We're going to look at this one first, and we're going to look at overfunded, and then we're going to look at overfunded with a front load, and then we're going to get into the term.
A front load means there's a dump in of money.
Yep.
and then still paying more than the minimum premium.
Correct.
And through paid up additions.
100%.
That impacts the cash value. It impacts the death benefit.
Yep.
So this is the one that a lot of people get frustrated about because they think, oh, well, this was all commissionable dollars.
Correct. Yeah, this is 100% base. And so when we look at this, though, even for 100% base policy, this is actually still pretty good because it's got $1,400 net cash value here, year one. A lot of times that'll show zero for a lot of companies, and that's where it gets really ugly. From the Dave Ramseys of the world, they can't stand it. There's like, why would you do this? And it's like a typical full base policy. Let's take a look here. Cumulative premium. You look at you're about year 13 before you break even, right?
Yeah,
that's about where we are. And so
some people are like, well, inflation is a problem.
Totally.
Like 13 years is a really long time. I'd be better off in a savings account and buying some term insurance, maybe.
Well, yeah. If you're looking at this,
if
you're looking at this as a savings alternative, right? Like, and you're comparing it,
which
to
is not an investment, and
right.
That's the thing is a lot of people look at this as an investment instead of a fixed income, which would be things like bonds and I don't know, even maybe annuities or CDs or money markets.
Yeah.
Like as an alternative to that, it's going to lose early on, but there might be a time, depending on how it's designed, and that where you'd be further ahead.
100%. And then you compare this. Let's just say, to keep it really simple, we're comparing it to a savings account. And so like you're looking at this being like, well, a savings account, I'm going to be fully liquid right away. This one, you're not even until you're 13, and then you take inflation into consideration. So you're really not like even. Purchasing power's gone down at that point in time.
Yep.
And so it's a tough conversation. Like I could make an argument that there's added benefit in here that makes it worthwhile. But when you look at this, I mean, it's a harder conversation to sell. You know what I mean? And honestly, I believe that, while people are better off doing this than not doing it, it's not ever. I would never ever position this to sell to somebody, like, because it's not the most efficient way to do it, in my opinion. Right. And so what we're always looking at is trying to overfund it and blending overfunded whole life and maximizing.
What about the people saying overfund? You're now putting more money in, and they look at it as an expense.
Yeah, we're going to talk about that. Yeah. We'll compare apples
to
apples, right? So like when we look at this, and it was year 13, was it, as the break even, where we put 70,000 in cumulative premium and we have a cash value of 77. So not even. It's year 14. We're 84, and then 86. We're a little ahead at year year 14.
Slightly ahead.
Okay, we're slightly ahead. So now let's go to the other one where we have $6,053 in premium. Year one, you can see instead of having $1,400, we have $4,800 in cash value. So there's still, we're taking a little step back. There's a little liquidity crunch, but it's much more liquidity, and it's going to grow in a much more efficient way. So you can see, actually, I'm going to go back here because this is an important number to kind of look at. And this is where you could make an argument for this base, full base policy, is that if you look at year 7 here, you could see this net increase in cash value is going up 6,304. So you're paying $6,000, but this is the year at year 7 that the policy actually starts to become efficient from a cash in, cash growth perspective. Right. So you're still waiting 7 years. Right now, when we go down here or over here to the overfunded version, you're looking at it's year 5. So it accelerates. You're paying in 6,053 and it's growing by 6,415 in year 5. So you get a couple years of acceleration. You have much more cash value liquidity, right? So it's been a more efficient policy, from a cash perspective. Death benefit, it's not a big deal breaker. Like if you look over here, you start with 128 versus 110. So you actually, with a full base policy, have more death benefit on a permanent basis, which is a good thing, right? That's an added benefit. But once again, like this is a solid policy. We're looking at the cumulative premium here at 54,057 there. So you're breaking even. You're a little ahead in year 9. So you're 5 years ahead, right? From that perspective. So people that look at it as a banking alternative, so to speak, or that sell it as that, and we deal a lot with real estate investors and people that want liquidity. This is as people that want to work towards, accomplishing a goal. Because a lot of times people come in and they say, hey, because, on our channel, we do a lot of videos of like, $20,000, $30,000, $40,000 a year premiums, because that's who we work with a lot, right? And then I get a lot of people like, well, what about us that can't afford that? That are doing $6,000 a year. And so this is a kind of a great example of being like, hey, if you want to work your way up, if you believe you need an emergency fund, if you want to like set your financial foundation, to me, this is great because you could put your money in a bank account, and that's one thing. And you'll have your emergency fund there, but that's it. And then we can have all these other conversations that I'll sure we'll talk about in a lot of videos that we're going to do today,
right,
about all the negatives about having it in a bank account. And this is going to be what I would call a self-completing plan, right? Like in the sense that like if you have your whole life policy as your emergency fund alternative, now you have the death benefit to back it up, right? Even though I would argue you need a lot more death benefit than this that we would supplement, and we'll talk about that as we keep going here. But you have the death benefit to back it up. You get living benefits with this. So if you get sick or chronically, terminally ill, as we were talking about at the beginning, you're going to have access to the death benefit while you're alive.
One of the interesting things, too, is if that's sitting in a savings account, the banks have had major failures with the money sitting in an insurance company. How many of these mutual insurance companies have failed? And I'd love for someone to tell me one.
Right. It's in the research that I've done, and actually I was talking to Barry Dyke about this, like Pirates of Manhattan. Yep, amazing book. But he said, and he showed the thing, and he wrote about it in his book, one mutually held life insurance company has failed since 1842. Okay? That's, guys, think about that. Through the Civil War, through like everything
World
that's
War I,
happened.
World War II, the Great Depression, the Great Recession.
You name it, right? We've gone through 3 versions of the U.S. dollar since these companies have been around.
Yeah.
Think about that. Like, that's the other thing. I mean, not to go on a tangent, we should do a different video on this completely, because this is one of my favorite things to talk about right now, is everybody's worried about the devaluation of the dollar and losing the world's reserve currency and the CBDC and all these things going on, right? You can manage that risk. I could manage my own risk if I wanted to try. I'm not that smart. Like, I feel like I'm a pretty smart guy. I'm not that smart, right? These insurance companies, this is what they do. They manage your risk. And when you think about why you're giving your money to a whole life company, it's to help you manage the risk of your safe money.
Right.
And when you look at it compared to a bank, and this is the only reason I call it a banking alternative, is because you're keeping your safe, liquid, accessible capital that you would normally keep in a bank in a place that you have accessibility to without the risk of the bank, because you're putting it with an institution that's got infinitely more success.
Right. And then, so there's the FDIC for the banks.
Yeah.
There's the Guarantee Life Associations for the insurance companies.
Yep. And every state has it.
Yeah. And like in Utah, $0 has been tapped into.
Totally. In
FDIC
180
got
years,
out
guys.
Multiple times.
Totally. Yeah. I mean, it becomes a no-brainer when you really understand it. And
I mean, where it's maybe not fully that is just simply if you're having cash flow problems right now,
right,
and you have, you don't have the cash to do this, you might have to use a convertible term to bridge that gap until you're in that position
100%.
And understand that it's a little bit longer view than a savings account.
You're solving
but liquidity is critical now and in the future, not just now.
And listen, there's a lot of people that sell debt elimination strategies utilizing whole life. I got a lot of challenges with that. There are ways that it works.
But when you got really high interest rates,
I mean, this
is going to take long.
Exactly. And so now
to get rid of a mortgage,
sure, totally,
this could be really easy because mortgages are a little bit longer term loan.
And we can talk about, the idea, the concept of like the most efficient way to pay off debt. And then there's also like the consideration of building financial security at the same time and finding a happy medium.
And where's your peace of mind and what's the economics and how do those work together?
And that's, once again, where life doesn't exist on a spreadsheet, right? Like there's way more than that. And so, but when we look at this.
So if we're comparing this to real estate, that's not a good comparison because we're talking about an investment class versus a savings vehicle.
Right.
It's easier to look at this as term and savings versus term and real estate, or term in a business, or term in a fund even.
Totally.
Right.
Yeah, it's a completely different risk profile. Right. And so this is going to be the safest money you'll ever have. Right. Like, I mean, that just is what it is. And there's no argument of that. And even if you're worried about the devaluation of the dollar, I would argue to people, you need fiat money. Like, to anybody that thinks you can like get outside of the fiat money system yet, you're delusional, in my opinion. Right. So if you need to have fiat money, put your money here, because to me, These guys are going to manage the risk. When it gets to a point where digital assets and all that stuff makes sense from an economic perspective,
from transactional
perspective, I promise you, life insurance companies are going to beat you there. Like
some of them already have.
They already have
Bitcoin and
exactly. So I will let them manage my risk in that transition. You know what I'm saying?
Yeah.
And that's what I love about this. You have your money in a bank, it's pure fiat. Think about that. Like, that's super powerful.
Yeah.
That's a different video. But
okay.
But so there's that. So this is cool. You know, like we can go down through here and you could see I did a 20-year term rider on this just to kind of show it. And so after that, it's just going down, you're paying the base. You can keep going on it. You can see, you know, here at year 30, at age 70, you've put $133,000 of cumulative premium, and you got $267,000 of cash value and $362,000 death benefit, right? Like, so this isn't a sexy thing, right? No. It's not going to blow your mind. It's just going to be a good foundation for everything you got going on.
Right.
Right? Like that. And that is the intent.
You want to figure out your investor DNA.
Yep.
And where you're going to invest for cash flow and for growth, but this as a fixed income alternative, as a savings alternative, as a place that you might even tap into in the right moments when the market's down or when the deals are there and this doesn't go down, but the cash is available. Bingo. Could be very instrumental.
Love it. Exactly. And so now, and I want you to go deeper in this after I explain this, because what we did here, it's the same exact policy. Okay.
But it's some money up front.
But I added in $24,000 up front. Okay. And so what we see here is the liquidity. You could see we added that $24,000 up front. Almost all of it is liquid, right? Which is fantastic. And so we got $27,589 is the net cash value out of the $30,000. So that's over 90%, right? 27 would be 90%. You get more of a death benefit because we got to do a bigger term rider that goes to get the $24,000 in up front.
Right, because if you put in a certain amount of money, there's the modified endowment contract limits, which is where the government's saying, at this point, you no longer get your tax advantages, right? Because you've funded it past that line.
Right. And so we've had some people recently commenting on videos like, why would you put money into a whole life? It's just an expensive, like, money sum.
And you got to borrow from yourself.
You got to borrow from yourself. But look at this. If you're comparing this to a savings account, right? Year 2, we're putting in $6,000. Yeah, sure, we have a little liquidity crunch up front, but look at all the benefit we're getting from it. And then as we look at this from a long-term perspective, and I'm going to ask you some questions and get you to go deeper in it as we go through this illustration specifically. But then you look at this year 2, you put in $6,000, it's growing by $59.41. You're basically even year 2 from a dollars in and growth perspective. Tell me how that is worse than a savings account when you look at the death benefit that you get above it.
Right. Like, and you won't be paying tax on the increases.
Exactly. Like, that's huge, right? And so then, you know, year 3 and beyond, it's going to be super efficient. By year 10, you know, you could see 84,000 cumulative premium. Or where is the break even here? The break even's year 6. That's like the power of front loading these things.
Well, it's
that's
like
why
in year 5, you put in 54 and there's 53.
Okay. Yeah. So, I mean, like, that's amazing. Like, and
you have $498,000 in death benefit, which if anyone plans on having a lot of money, death benefit becomes especially important because then people get frustrated with the state taxes in the future.
Yeah.
Or as my friend Vince Dodonna says, he says you could turn your small assets into big assets.
Yes.
Because it unlocks that you could create more cash flow with it. And I wrote a lot about that and what would the Rockefellers do. There's other videos we do on that.
Yeah.
But yeah.
I love it. And so when we look at this and you compare it by year 5 or 6, at least, this is going to be ahead of a bank account on a liquidity perspective. And remember, we're not comparing this to investments, and we're going to keep beating that one, right? Like, because people just don't seem to get it that don't agree with this. This is a savings alternative.
This exists that we're in because I used my cash value for it.
Right.
Could I have used the bank? I don't know, because I had to close quick. There was other people that made offers.
You might have lost the opportunity.
Might not have had the opportunity.
Exactly.
Right? So what's that external return? What's that benefit? Now, maybe I could have just had that in a brokerage account and borrowed against my funds, but I don't love the stock market. That's not my area of expertise. I like intellectual property. I like real estate that I utilize, and I like businesses that I create. So that's a different portfolio than stocks, bonds, and REITs.
Not to mention, if you were borrowing against those other assets, you're probably not going to have as high a percentage of liquidity of those assets as you would in this. So you need more to leverage.
Right,
less,
because if it's a variable asset or more volatile, there's a lower amount that you have access to.
And the interest rates typically are a little higher than what you're going to get here. Right. So there's, like you can, that's why it's not just about the return in the policy. It's about what is your investor DNA, right? Like what is, like, as you would say, right? And so that's a big thing. And so as we look at this, though, this is what I would say for somebody who's like looking to get into real estate or looking to start a business or wanting to have an opportunity fund is what I would call it, right? Yeah. This is the way to start. Like you got a little money in a savings account. You're already kind of like have that saver kind of mentality. You want to get ahead of things, but you're like, oh, you just discovered this. And you're saying, hey, like, whoa, there might be something here.
Less cash up front, but then tax advantages without restrictions till 15 and a half.
Right.
Not having to pay for term insurance separately. Right. That money's now recaptured, and we're going to look at a term insurance policy.
Yep.
Extra benefits like liability protection that exists inside of this, right? FIFO, which means all the money you put up front, you can pull out first,
right?
Not even taking a loan, and there's no tax on that.
Right.
Where most of the time it's LIFO, the first dollars out are the first dollars taxed in LIFO. So like there's these nuances, and it is interesting because there's these like memes or cliches or sayings, which is like, oh, you have to borrow from yourself. Well, actually, you don't. Your money stays in there and earns interest or dividends, and then the insurance company lends you their money.
So there's two phrases in the life insurance business that agents and influencers and everybody get wrong, and you and I are so similar in this. Like words matter, right? A lot. Semantics matter. We just had this conversation about hacking, right? Like it is what it is. Like borrowing from your policy and paying yourself interest is something that people use all the time. You are not borrowing from your policy. You're borrowing against your policy. Yep. You're leveraging it as collateral, getting a loan from the insurance
company. Which keeps your money in there earning an uninterrupted curve of growth.
And you're paying the insurance company interest. You're never paying yourself interest.
Right.
Which is something a lot of infinite banking hacks.
Yeah.
We'll go out and say.
Right, but those, it matters.
Yeah, it matters a lot. And once again, I come from a marketing background too, where it's like a confused mind always says no, right? So when you start talking in these semantics that like don't make sense, right? People go, well, how can that be? And they're confused and they go, well, that doesn't make sense. I'm just not going to do it. I'm not going to look further into it. Or they look at it and they like poke holes in it.
And in the context, this is like chapter 2 of what the Rockefellers do. The context of if you're looking for the lowest price, not considering the economic impact or the value, you're just going, well, right now, today, I can get term for less than I would get this. And why would I put 24 grand in up front?
Totally.
Well, we just showed why you might want to do that. But in a myopic view that's just only looking at one dimension, you're like, lowest cost possible so I could then save more money on the side.
So let's talk about this real quick. So I don't care what type of insurance we're talking about. It could be whole life, IUL, term, variable universal life, guaranteed universal life, like any platform. Everything is actuarially driven. Everything. There is no free lunch in this life insurance game. Fair enough?
Right.
And so when we look at this, and we're going to get into this deeper as we get into the term insurance, and we're going to dive deeper, everything has a cost. And are you paying a little more for your insurance up front with whole life? 100%. But you're locking in that value over the period of your entire life. And anybody says that you should just buy term, invest the difference, and you're not going to need insurance when you get older, I could list off.
Chapter 7 of Killing Sacred Cows says there is no such thing as self-insurance. There's either you're insured or you're not insured.
100%.
And when you're not insured, you're using your assets, locking them away. Because if you don't lock them in a place where they're liquid and available, or there's too much volatility or liquidity, you're exposed in a way that if that claim happens, like you don't have to have homeowners insurance.
Totally.
It's not required if you paid off your mortgage.
Do you know?
And you would save $1,000 a year or whatever it is. But how much money would you have to have set aside in case something happens to that home? And what happens if you lose that home in 2020 when supply costs went up massively, demand for building went up massively? How are you going to get that handled for the price that you had set aside?
Yeah.
And what if there's some liability that happens on that property?
Yeah.
You're now exposing your assets beyond what you have, where it could actually start to be against part of your income. 100%. And so it's a view where we're not transferring risk. And when we retain risk, we behave differently. And when we retain risk, we lock up our money. And I look at it this way: if I don't have insurance every dollar I think I'm self-insuring is costing me at least that dollar, and what interest I forfeit earning on it because it needs to be liquid. If I am buying insurance, I want to pay pennies on the dollar to transfer that risk so I can now use my money. So instead of trying to save $1,000 on homeowners insurance, what if I could take $250,000? Could I earn more than $1,000 with $250,000?
I hope
easily.
So.
Right now in treasurers, we could do that.
Yeah, easy.
So let's say that's 5%. We're talking about $12,500. That's $11,500 ahead. But I also now have liability protection that I wouldn't have had. And I have extra protection when there's fluctuations in the price of replacing a home. And so I don't think anyone hates insurance. It's just we hate paying for it. And I don't think that the best way to insure is to be the cheapest, because the cheapest way to insure is to transfer the catastrophic risks and then only take on risk that we can write a check for and go to bed that night. I call that the inconsequential risk. But death is a very consequential risk.
It is. And when you look at, listen, there's different types of term insurance that can have living benefits. Most people look at term, like Dave Ramsey, I'm just going to focus on just the cheap of the cheap term, just focus on the death benefit myopically, right? The reality is when you talk about catastrophic risk, obviously death is the worst of that, right? But in a way it's not, because becoming disabled when you're in retirement, living with
living death, kind of like where you no longer can provide, and you might have to have a lot of structure just to support being alive.
And now you become a burden on your family.
I mean, financially,
right? And even a lot of times emotionally intact. I mean, like your family may not mind, but you probably do, right? And your dignity and you know what I mean? Like that's tough. So when you follow these plans of being like, I just need, like, let's just take all the money aside, when everybody says you don't need whole life insurance in retirement. Did you know, I was reading this article the other day, 70% of bankruptcies and foreclosures in your retirement happen due to medical bills? Okay. So, and that's because of disability, needs for long-term care, things that happen, right? Following that plan and getting rid of your insurance and all that, that exposes you to that risk. Whole life insurance is about way more than just the death benefit.
And this is the problem with high risk equals high return mentality.
Yeah.
Hey, if I take high risk, I'll get high return, because look what aggressive funds have done long term. Yeah. But what it doesn't take into consideration is distribution, contingencies, factors outside of our control with tax fluctuations, interest fluctuations, inflation. And so what happens is, through naivety and through simple misinformation, we chase something that's non-existent. And then when we get to this point where we're supposed to use it, we're exposed. And that exposure creates a sense of fear and frustration, because we're an incident away from that legacy being confiscated. And we're talking about real human lives and real human living that we're now ill-prepared for, because people saw insurance only as a cost and expense to be minimized instead of risk to be minimized. And 100%. That's a huge distinction.
Oh my God.
What if you're thinking about minimizing risk versus minimizing cost? And what if minimizing risk minimizes your cost long-term, but increases it short-term?
Yeah. It's worth it.
It's probably worth it.
Probably worth. I did a funny video you just made me think of. It wasn't even funny. It was kind of tongue-in-cheek funny about a year ago. And it was like how buying a whole life policy is going to help you live longer, right? And I actually, I said it tongue-in-cheek, but I actually believe it, because having a whole life policy is going to be a foundational bedrock to your finances. That's going to give you more peace of mind, less stress, more confidence. And that alone is going to help you live longer and healthier.
Right. So if we're comparing rate of return on a portfolio to what your cash value is, I get it.
Yeah.
Cash value. Yeah. But who's out there comparing a savings account to a portfolio?
Right.
Right. You don't hear that.
No.
And maybe it's because too many people call it an alternative to investing. I don't. Right. I think of it as buy the death benefit, because that's buying future access to my cash that would normally be locked away, because I don't want to self-insure, because that's being exposed. And through that minimized risk, I have options. So.
I think the problem right now is being exacerbated by the fact that you got a lot of IUL agents out there selling
that as an investment.
IUL as an investment alternative to a 401k, and that's their talking point. And so that kind of spills over into these areas. But you need to understand the difference between the two and the different philosophies.
And we've done videos on that.
We have.
Yeah. All right. What do we got here?
All right. So here's, I want you to just talk to me about the power of this, right? Because when you look at this, we could have the alternative of keeping it in a bank account, but we've put $84,000 in. Let's say you're 10 and you're looking at this as a long-term perspective, and you're a real estate investor or an entrepreneur or somebody. talk to me about the value. Explain to somebody the value of having this $93,000 here to go with the $500,000 of death benefit to, like, you know, Nelson Nash, the one thing I always loved, he said, is like, the more I have in my policies, the more opportunity just seems to have a way of tracking me down, right? Like that statement alone, that about all the infinite banking stuff that I can bang on and like whatever, that alone, like that statement to me is one of the most pure.
Well, because most people don't have access to cash when the biggest opportunities are there.
Right.
What happens is a market goes down.
Yeah.
And that market might impact small business. It might impact the entire economy, but it doesn't mean that that business isn't valuable. It just means it's doing less because people are cutting back.
Yeah.
And because of the fear of those accounts going down and the way they feel about it, they don't know what to do. And there's huge opportunity because people are looking like, I need to get out. And you might be able to buy that real estate at a price that would never otherwise be available, that business at a price that would never otherwise be available.
Yep.
But if you're losing money in the market during that time, are you going to take the 20% hit? Are you going to take the 30% hit? Probably not, because you're told, be in it for the long haul. The market is going to come back. This is just a short-term thing. But if you have cash that's locked in and it's guaranteed to grow during that time, and you could get access to that by taking a loan against it, now you can capitalize at a time where most deals are happening and most wealth is being made. Depressions, recessions, and economic turmoil is where people are looking for, how do I get out of this situation I put myself in?
I love it. And so as we look at this, and we look at the cycles of markets, right? We look at like the dot-com bubble, the Great Recession, 08, COVID, like it's those times when more wealth is created than others. And so my philosophy, and I want to hear you talk about it, my philosophy is like, I'd rather not make money when other people are doing well, because there's this like false sense of like, I mean, we'll make money during that time, but I want to be safe and I want to like really capitalize when, you know, Warren Buffett always says, when there's blood in the streets, when there's like, you know, when
it's a hard discipline for sure.
Yeah.
But then you don't, like, I find my wasted time in my 20s were chasing returns because things were going so well and everybody's getting involved in something. And now I'm distracted with all these real estate deals and they're super competitive and everyone's getting into them and everybody's making money because it's this artificial demand. And I'm now derailed from the things I love doing, chasing something. And that's what happens with greed. But when all of a sudden things aren't doing as well, that's when I acquired a business that really expanded my reach and the functionality we had with the team that we were able to get, right? That's when everybody else was holding tight and scared. And so awesome. It was able to happen faster. I was able to create capacity with my investor DNA. Most of the time when markets are going good, it's not aligned with our investor DNA. It's aligned with simple conversation and cocktail parties and people making us feel bad that we're not getting involved and that we're not doing enough and we're missing out on this gold rush. And the thing is, most people get really hurt during that time because they buy eventually and it still comes back down because there are people that are really good at value extraction. And a lot of those cycles are value extraction cycles.
100%.
Because of derivatives and options. One person's betting it goes up, the other person's betting it's going down, and the people that are sitting there long are just, you know, getting taken through flash trading, getting taken through, you know, volatility, getting taken through, you know, like, why is it that 84% of the market returns over 20 years happened by 10% of the investors?
Wow.
Is it just because of size? Or is it because some people are making 3% because they're not hedging and leveraging and not using hedge funds and they're just sitting there long and waiting? I think a lot of it's that, not just, you know,
Well, what I love about this is it's not that I always call, do you remember, do you ever watch the NFL back in like the 90s? So do you ever remember the commercials on BASF? Like they always did the commercials. It was said, you know, we don't make the fishing line you buy, we make it stronger. We don't make the paint you use, we make it brighter. At BASF, we don't make the products you buy, we make the products you buy better. Right? And so I look at whole life. Whole life isn't the investment you make; it just makes the investments you make better.
Right. So as an example, when you go to take income, what if taxes skyrocket one year? You could use your cash value rather than your 401k, which is going to be taxable.
100%.
Or what if interest rates just sink to very low amounts? The dividends are going to be better during the times when interest rates are really, really low.
What if interest rates keep going through the roof right now? Having access
to cash to be able to capitalize on that, because when it goes up, people in bonds, they're losing value.
Right. You have a bunch of money in a whole life policy when and you're dealing with a market where interest rates are 10, 11, 12%.
But Chris, I could buy term.
Yeah, I know.
Let's show the term.
Right. And so this is really powerful. So like, let's just look at this though. I mean, like, okay, so it goes down. You can fund this. It is what it is. You got $400,000. When you hit 72, 368 at 70, it's growing. The death benefit is there. This is really solid. Now, once again, this is not enough death benefit. Like if I'm earning $60,000 a year, it's, in my opinion, this is still not enough death benefit to take care of my family, replace my income, make sure that I'm taken care of. So our philosophy is like, if this is all the cash flow you have, is to do this, but then also do a convertible term policy because you want to lock in that human life value, right? Economic value. And so now what we have here is, let's take a look at a term policy. I have two policies that we're going to look at from a term perspective. We got a 10-year and a 20-year because I think it's important for people to look at the difference between the two. And not just for the term of the 10 years, because if we do this is a convertible term, meaning you can convert this up until, I think it's year 8 of this policy. You can convert this to exactly what we were just looking at, right? Like you could convert this to this on a guaranteed basis. You lock in your insurability. Let's say you're super preferred, right? And 6 years from now, you're not super preferred. You're diagnosed with cancer or something like that. You can convert this to
preferred, the best possible rating.
Best possible rating, period, right? And when you look at this, $550 a year for $1 million of coverage. That's pretty solid.
Mainly because you're not likely to die.
Right. Yeah. You're not likely. Yeah. Right. But over a 10-year period. So remember what we were talking about earlier. There's no free lunches in this game.
Right. This is why someone's like, well, look, I could pay $5,500 and get $1 million of death benefit. Right. You're showing 130.
Right.
But when you stop in the 11th year.
Right. And mind you, this $550, you could go find $1 million death benefit.
Cheaper.
Way cheaper.
Won't be
for like half the price, but it won't be convertible. Yeah. Right. And so there's once again, no free lunch. Right. And so when we come to this, we look at this and we go, all right, after year 10, this policy becomes what's called an annual renewable term, right? And so you have to say, hey, if I want to keep this, I either can choose to, if capable, go back through underwriting and get reinsured. Maybe you're not super preferred anymore. Maybe you're just standard or whatever. And you could buy another term policy, which now you're 51. And so it's going to be much more expensive at that point in time for 10 years for the comparable coverage. Or you can pay $9,370, and then the next year pay $10,000. You're paying per year, and you asked a question, and I'd never really thought about it this way. So like you asked a question earlier before we started this video, is like, what year is a cumulative premium equal to the death benefit? And the fascinating part was like if we go down here and we look, year 77. You got
age 77, you're 37.
Age 77, you're 37. You got $1,054,000 in premium and $1 million in death benefit.
Right. This is how it becomes really profitable.
This is
for the insurance company.
Yeah. So they know everything is actuarially driven. And so, like, just for a second, this isn't the purpose of this video, but like when we talk about Index Universal Life, it's built on an annual renewable term chassis. So this kind of shows you the power, like how life insurance companies up front, why they say IUL is cheaper than whole life, because up front it's annual renewable term. So you're paying less and less and less. Whole life, you're paying a little more up front, but you're leveling it out.
Right. And the IUL people will be like, yeah, but you're only being charged on the difference between your cash value and your death benefit. And we're going to get that so high that you have a very minimal amount at risk that's being charged. But then how do you ever use that cash?
Yeah, exactly. And if you use the cash, you inject a lot more risk in. And like that's a whole different bag of worms to open. Right. And so, but you can see the amount of insurance that's required here, the cost of insurance that goes into it. And as you get older.
Because they have no control over your health at that point. So
exactly.
They're phasing you out.
Exactly. And so what we have here is this is the 10-year. And then when we go down over here, now we have a 20-year policy. So now, once again, they're actuarially
$330 more.
$330 more. But that's over a 20-year period. And then you can see at age 61, it goes to $19,930 compared to $19,930. Ironic?
Yeah.
Huh?
Yeah. There you go.
So like it is what it is. Like the cost.
Well, and that's what your cumulative premium on this is $141,000
at age 20.
At age 20, let's go.
Where if you take a 20-year term, you're only at $17,000, right? Like so, it is what it is. And by doing this, you actually extend the conversion period as well, which is really sweet.
Right.
Right. Like so, to me, a 20-year term here makes all the sense.
You're basically paying $330 for a 10-year option.
I mean, seriously.
Right. You get 10 more years
for sure
at a better pricing, but
so,
you pay the cost of money that first 10 years.
100%. And so like when you look at like just to kind of summarize all this, we have the base whole life, which like it's better, like, you know, it's not horrible. It's not as bad as people make it out to be, right? It definitely, I think, needs to be more optimized for the use case that most people are looking for. Mm-hmm. And that's where we go to the overfunded component.
I have some policies that are based my whole life.
Sure.
Haven't overfunded.
And that's fine.
And I have overfunded policies. I have both.
Right. And I think having both for different needs, right, are important. I'm right now I'm going through underwriting for another term policy, but I'm doing a term policy not for conversion, not for the insurance, but because I want it for the living benefits. There are certain companies that offer living benefits term that you get access to like 60% of the death benefit if you get diagnosed with cancer.
So it's like, to me, it's like your,
it's like my high, the high deductible medical plans or whatever.
I miss those.
It's like
I miss those.
It's like
my first medical insurance was $79 a month.
Right. So this for me, by the way. So why do I want insurance? Personally, I'm really healthy. I'm really intent. You know, like whatever. But things happen. Right? Mitigate risk. And so if I were to get cancer, I don't want to have to like just listen to the insurance company. Right.
Right.
I want to control my own medical directive. And so having
because
access,
the insurance company is going to give you one option.
Exactly. Chemo, radiation, all the things that I refuse to do. And so by having living benefits term, $80 a month, man.
Right.
I have access to $500,000 if I ever get diagnosed with cancer.
Right.
Like,
so that's
it's a no-brainer.
Yep.
Like, but people like, so they're different solutions, different reasonings, whatever. But as we look at this, you got the base, you got the overfunded, you got the front-loaded overfunded, and then you got the term. And in my opinion, everybody should start with 2 policies. At least one, if your cash flow sucks, just get a term.
Convertible.
Buy this 20-year term.
Yep.
Lock in your human life value, and you can convert. The other part about this is you got this $1 million death benefit here. You can convert 10% of that at a time.
Yeah, it doesn't have to be all.
You don't have to do it all at the same time, right? So you're basically, we talked about this last time I was up here, right? It's like buy your net worth and build your cash flow, right? That's what you're doing here, right? Like I would say if you're just doing this, you probably want like $1.5 million in this situation, right? But get that $1.5 million locked in, and then as you build your cash flow, convert it, and build the whole life policies, overfund them, do your thing.
All right, there you go. That's the basics. We've just shown it with some numbers. Understanding is an alternative to savings as a way to protect your capital when interest rates are fluctuating. Access to capital along the way, still have tax advantages, have some riders that can maybe enhance the benefits, and ultimately put yourself in a better direction.
Awesome.